To kick off the afternoon sessions, I'm excited to introduce the panel Bridging Decentralized and Traditional Finance. So as a fintech professor here and general fintech nerd, I am incredibly excited about this panel. It kind of communicates some of the things that I've been teaching here over the last 7 years, just about financial innovation, kind of evolving the ecosystem, and some of the projects that we're going to talk about in the different areas of the ecosystem I find really fascinating. I'm going to introduce Jan VanEck. Jan has been kind enough with his generosity to form the VanEck Digital Assets Initiative, which is housed in the Marshall School of Business here at USC. I'm thankful to be involved with that. Jan is an innovator, an entrepreneur in the ETF world, and he's going to be the one moderating the panel for these great panelists. Thank you.
Is my mic working? Oh, yes. Okay. My name is Jan VanEck. I'm really excited to be hosting this panel. We have 3 founders and another co-investor. So it's really exciting to be able to focus really on them as business people. So the other thing I wanted to say is we might have time for questions. I think it would be great if you do have a question after we've gone through some of the material, just come on up and shout. And we want to include the audience. So I guess first of all, actually I'm going to start with you, Lauren. Could you just explain, since you're my fellow investor, I'll call it loosely, just explain the theory of your fund and your perspective on blockchain.
Of course. So I'm Lauren, I work at Pantera Capital, and we're one of the oldest institutional crypto funds. We invest into almost anything related to the sector, so it could be equity, pre-launch tokens, or publicly traded tokens. And we have primarily invested into a lot of the infrastructure like picks and shovels in the space, both CeFi and DeFi. As well as a number of applications.
Great. All right. Well, let's start. We can't go into a lot of depth about all the different parts of the ecosystem. We've got stablecoin, we've got lending, we've got DeFi. But tell us a little bit about your projects, and then we'll talk about maybe some of the growth obstacles or where you are, where that project is in terms of its trajectory. You think maybe competitors. And then I'll do some follow-up questions. Okay? Jason, start.
Hey guys, I'm Jason. I'm one of the co-founders of Frax. Frax is it was the first fractional algorithmic stablecoin, currently the 5th largest stablecoin by market capitalization, and the 2nd largest decentralized stablecoin behind MakerDAO. We launched Frax in late 2020. We did a lot of work with the DeFi space, partnering with projects. The current market cap of Frax is close to 1.25 billion. As of today, and we've seen a few market up cycles, down cycles, and a few sort of market shocks. One thing that we really noticed with Frax as a protocol is that in times of sort of stress, you really get to see who's out there swimming naked and who really has sort of a fundamental approach to some of these sort of fundamentals, right? So for us, one thing we look at for growth is fundamental growth, good projects that look at where the space will be not only next year, but 3, 4, 5 years from down the road. Seeing as crypto is a very volatile, decentralized space, it's very hard to predict what comes next. So I think keeping an open mind, but also being aggressive in terms of where you might be looking is a good sort of balanced strategy.
So I asked you before if you hit a wall and how you're doing market share-wise this year.
Yeah. So Frax itself, we're the total market cap of the token at the peak was over 2 billion in circulating supply. Nowadays at 1.3, it's down a bit. Although being a stable coin, it's actually not doing too poorly in the rankings. Right now, as of today, we're around 37th in total market cap rankings of all cryptocurrencies. And so I think one of the things that we've seen with this sort of small contraction of both crypto assets in general, but also stable coins, is that in times of higher interest rates, a lot of the capital sort of coming into crypto, trying to find yield, is going out of crypto. But one thing for us as stable coins is we kind of understand that having a long-term view and being sort of heads down and grinding while the growth continues, kind of waiting for that next period of sort of relaxed or sort of higher velocity money is pretty important for us. So I think it's just patience, being aware of how the market behaves, and broader market cycles for us is one thing we pay attention to.
So one of the business questions that a lot of us face is how do you pivot? And so I think just if you could tell that story a little bit about how you're spending your time now is a way, sort of, to me, a larger way of growing the use of Frax.
Yeah, so one thing is specifically in sort of slower markets, right? In the sort of the bull market, it's very important to make sure you're in the right projects, you're in the right direction, you're working with the right people. In the sort of slower market times, or just in general, right, when you have more time to innovate, you're able to take a step back and look at the other verticals. One thing Frax is doing recently is it's launched into AMM and lending, Frax Swap and Frax Lend. So there's a bunch of different avenues with DeFi in general, but the three main ones are primarily stablecoin, lending, and market making. And so as a result, there's a bit of a way to sort of pivot and go for a broader full stack approach to decentralized finance, rather than when you first start off, you have to pick sort of one avenue, in this case, stablecoins.
Yeah, I think that's super interesting. Taylor, I'm going to skip over to you. Could you describe your project a little bit?
Yeah. So I'm Taylor. I'm on the founding team behind Goldfinch. We are a decentralized global credit marketplace built for a future when all debt is on chain. So we have a mission to connect the world's capital with the world's growth, and in doing so through the most trusted credit marketplace. So what this looks like is that we built a protocol that lends crypto to real-world businesses. So connecting kind of crypto lenders in the space to lend USDC to real-world entities, primarily in emerging markets, so fintechs and credit funds that are lending to businesses, small, medium-sized enterprises in emerging markets, and then also to the US entities as well. So it's been interesting. We were one of the first players in the real-world asset space on chain. So I think at the time, a year and a half, 2 years ago, our logo or our motto was crypto loans without crypto collateral. And if you said that today, that is like a total do not say uncollateralized. But we always had off-chain collateral. And so we always built with kind of the fundamentals and risk management frameworks of traditional finance, but under the guise and kind of guiding light of an ethos of crypto.
So even I understand borrowing and lending, so you've got two players in your kind of solution set, if you will. Can you describe the other moving parts?
Mm-hmm. So the Goldfinch ecosystem has many different stakeholders. The three primary ones are borrowers. I referenced those. So real-world businesses, entities, they come to the platform, provide a data room, so an NDA-gated data room where everyone can see audited financials, kind of the loan terms, everything that you would need to be able to evaluate and underwrite a deal. Once that deal is on the platform, there's kind of two tranches. So there's a junior tranche where kind of the second stakeholder or backers directly supply capital in doing that evaluation and due diligence. And then there's also a senior pool which will allocate across all of these loans. And that's a diversified kind of passive investment opportunity. And those are what we call LPs. And so when you're looking at the APYs of this, it's kind of each loan has, I would say, a 10 to 12% coupon. And so you're looking at stable USDC yields for the backers between 15 and 20% USDC APY. And then for the senior pool, so the LPs, you're looking anywhere from, I would say, 5 to 9% USDC APY. That's held steady throughout kind of all of the news events that we referenced today.
Where do you see your biggest growth friction, if you will?
So this is an interesting question. I think if you asked me 6 months ago, I was always surprised by how quickly LPs were willing to lend capital to the protocol, kind of no questions asked in a way. And now we're really moving towards, like, every call is about risk management, kind of what's the path to recourse if there's a default, and really moving, I would say, like, those are the questions that are being asked. I think a lot of crypto players or institutional investors in the crypto space right now don't necessarily have the global capital markets know-how or expertise to be evaluating these deals. And so without having that knowledge base now, they're a little hesitant to be supplying capital to something that they're not 100% familiar with as well. And so I would say the friction point on that front is a lot about investor education and making sure that people feel safe and comfortable doing deals that are happening in the real world every day and just moving those on chain. So that'd be for like the crypto institutional investor. And then on the other side, you have your crypto curious TradFi institutional investor as well. And that friction point is getting them to start operating on chain. And for them, there's the security risk. I think with a lot of the regulatory uncertainty, that's a huge friction point. And then, of course, I have some colleagues who are in New York at a very TradFi conference yesterday, and every single institutional investor referenced kind of what's going on with FTX and was like, we just really don't want to touch it for probably the next couple of months as the dust starts to settle.
Interesting. Yeah. We face some common problems. Jay,
Yeah.
tell us a little bit about your story.
Hi, everybody. I'm Jay. I'm currently the CEO of Pentagon, which is a research lab focused on finding like cool applications of Web3. Personally, I'm of the view that crypto hasn't found its killer use case beyond stablecoins, as Jason mentioned, and we're looking for what else it can be. Before that, I started Rari Capital, which was a lending and borrowing platform, grew it to about $1.5 billion, and then it merged with another DAO at the end of last year. I'm also a junior at USC.
Tell us a little bit about Rari's growth. Why did you merge? All that kind of story. Like, where did we all hit friction points, right? That's what I'm trying to get at. What were the friction points there?
Yeah, I think that there were a lot of friction points with Rari, right? So Rari started out as not a lending and borrowing platform. Started out as a yield aggregator. And what we realized is like, wow, we had a bunch of tokens that we had created and we wanted to borrow against them. And there was no service to do that. So we're like, let's build a service to do that and enable anybody to lend and borrow anything instead of having token holders, centralized entities, anybody tell you what you can or can't borrow. Let anybody borrow and lend absolutely anything. And that was the mission behind Rari. And it worked out really well, right? Especially as the bull market went on, a lot of people wanted to lever up on their shitcoins, and they couldn't do that anywhere else except at Rari, right? There were a lot of people who used their OHM or whatever to buy houses, to do all this cool stuff in the real world. That was really awesome, right? And we had built it for a future where houses were tokenized, where property was tokenized, and people could borrow against all of those tokens using our platform. But as you mentioned, there were a lot of blockers to that future, right? The biggest one that hit Rari was in March, I think it was in March of 2021, we got hacked for $13 million, right? And that was hard. Couldn't sleep for like a weeks after because I was asleep when we got hacked and didn't see it until the morning. And I think that our community came together the day after. We had a 450-person community call, worked together as a community because we were a decentralized protocol, and everybody who lost money got repaid after, I think, 6 months.
How did you do that mechanism?
Yeah, so that was part of the motive behind the merger at the end of last year, is that the people who we merged with had over $1 billion of book value, so they used a part of their money to pay off all of the hack victims.
Wow, that's great. Lauren, feel free to jump in if you have questions.
Yeah, I guess actually Taylor hinted at this a little bit, or you're talking a little bit about risk. And I mean, given what's happened over the past few days, I'm curious how the three of you think about the different, how you think about risk management and how that differs from if you're building a centralized company, for example. Maybe Jay, we'll start with you.
Yeah, I mean, I think that centralized institutions will always trend towards corruption over a long enough time frame. And I think that's why decentralized institutions are so important, right? And that's why we're building and talking about DeFi today, is because this is gonna make what happened to FTX not possible, right? If FTX were a DEX, this would be all auditable on-chain, and anybody could go and do that. Right, so in terms of risk management, the best risk management is to not need to trust anybody and just trust code instead.
Just to add on to what Jay said about centralization, I definitely agree with this point about the risks of centralization sort of trending towards corruption. And I think that one of the issues sort of plaguing the industry right now is you sort of see that sort of jumping the river moment where some of these centralized companies and centralized entities are sort of being a bit too old in this space compared to these new decentralized companies, which are more operating on-chain and through DAO mechanisms. Although I do think that there's also a need for centralization, especially in their early bootstrap phase, and that's why we saw the rise of all these exchanges and their operating models. is because, at the start, it's simply too difficult. Maybe there's not enough people in the specific ecosystem to have a purely decentralized ecosystem or a decentralized operating model, whereas the centralization model sort of gets you there to a point where everyone's sort of on board, understands the playing field, and understands, the best behaviors and mechanisms to the point where we can actually have a thriving decentralized ecosystem.
Well, Alexander Hamilton would be very happy because the founding fathers set up our whole government as the checks and balances with this lack of trust. But I'm not as distrustful of centralization as my co-panelists here. But I did want to dig into, there are some business practices in crypto, especially during the bull market, that makes anyone uncomfortable. There was a lot of sort of pyramid scheme types of tokenomics, and then offering tokens to do different kinds of incentives to hack growth, I'll call it, in an unhealthy way. And I'd like to ask you, sort of, give us an example of business practices that you haven't done and why, or that you've seen adjacent or that your competitors have done that have made you nervous. Because I think if you're builders in the audience, you're gonna see this in your career. Maybe sooner, maybe not while you're out of college yet, right? But so I think it's helpful just to hear some of the stories in the context of blockchain.
Yeah. I think that one thing that we've kind of seen as a decentralized protocol is sort of the behavior of somewhat centralized actors coming in and trying to push a certain agenda or trying to influence public opinion, and then through that sort of rhetoric have a negative impact on the space as a whole. And I wouldn't be talking about just recent events, but I think throughout the whole history of blockchain and Bitcoin and cryptocurrency, there's been a lot of sort of actors who come in, they see an opportunity in the space, and they see a way they can carve out and do some rent seeking or something of that sort. And although that's somewhat just the essence of business and a revenue model, I think there's actually a lot of space for blockchain and cryptocurrency and decentralized finance to keep growing. And I think we're actually at the point where we can still have new innovative models that don't rely on just rent seeking compared to a very old and perhaps sclerotic industry such as telecom, right? I think that in the blockchain space, there's still lots of room to grow. And one thing that has always put a bad taste in my mouth and made me a bit anxious is sort of seeing people who come in looking for sort of an end state system to sort of extract and behaviors of that sort. So that's something that I myself have always been a bit wary of, and why I always enjoy working with people who have sort of a forward-facing view of decentralization, but also just open access and open code, open collaboration.
As a stablecoin provider, some stablecoins will pay centralized exchanges to list. Did you face this issue? Sorry, I didn't prep you for that question, but I mean...
Sure, yeah, happy to take
and feel free to name names, guys. I mean, we want to liven up the conference.
I will, in the view of being long-term, I won't name names, but there has been sort of exchanges, that would like to have market makers offering their service, sort of this ecosystem where, in the exchange's point of view, they don't want to have their traders, take a bad hit because of low liquidity, right? If you were buying Bitcoin, for example, and you just bought too much and it just slipped the price by 50%, you would be quite angry if this problem wouldn't exist on Coinbase or Binance, for example, right? But, in the case where there's sort of a need for a market maker, we've run into cases where these market makers will ask for sort of a large fee or a very non-regular fee structure that we ourselves think is a bit unreasonable. But I think actually this highlights the sort of topic of going from centralization to decentralization. Whereas in the centralized world, back in 2017, 2018, you saw this a lot of ICOs. Is that the only way to get liquidity, for the most part, was on a centralized exchange, right? And the issue with that is that it gives the keys to the kingdom to the people who are listing, on the listing teams of centralized exchanges. And so as a result, these market makers who grew their business during this period of time were able to sort of get used to a very lucrative business structure, which was at the benefit of them and somewhat of the exchanges, but not of the projects, right? And so one instant key benefit of decentralization with Uniswap and these other decentralized exchanges is that there's no listing fees anymore, right? You just deploy a contract, it's good to go from day one, and it really lowers the barriers for all this sort of access to liquidity in the space.
But the CeFis, they offer convenience.
Yeah,
right?
and
so what is...
Yeah, and I will say, right, like, again, it's a balance, it's a mix. I don't advocate for pure decentralization only. There's a lot of places where decentralization is actually required, either for the incentive structure or just for the network effects that don't exist yet. So in some sort, you need sort of, a strong core leadership team that will actually bring you to the location where, market participants as individuals might not see right away. So I think having a good blend between centralized finance in terms of the expertise, sort of the long-term view, and also some of the wisdom and tricks of the trade, mixed with this sort of open access, open liquidity environment of DeFi is a good way forward, both for individuals individually, but also as the ecosystem as a whole.
And I just have to highlight something that really surprised me. Your biz dev team was how many people?
So we actually, for the first year, we were 3 people. So we ran the protocol from 0 to $1 billion with just 3 of us. I was more on the technical side. So Sam, the first founder, was actually pretty much doing all the business development work. And so for us, right, we kind of got to that state where we kind of realized, in the modern day especially, to start, to be doing a tech or sort of a new tech company, it really doesn't take many people. It really just takes expertise. So having that sort of tight-knit team is really important, but also being able to be lean is something that is, extraordinarily valuable in a very volatile industry.
Sorry for all those questions, Taylor. What's a business practice that you've seen that you'd like to talk about?
It's a tough question. I think where centralized exchanges come in, and you were talking about market makers, is that there's this North Star towards liquidity or towards TVL or towards certain kind of gold standard metrics that I think can sometimes warp or kind of act against the best practices or good faith of certain projects. So for instance, I think 1.5 billion is incredible, but when we're talking about certain projects, I think a lot of projects end up using a token in order as a customer acquisition cost, and then they're not necessarily thoughtful about kind of the governance or the utility of it. And I know we're a decentralized is a much better system than a centralized entity. So then how do we respond to something like the Mango hack, where it is completely decentralized and a poorly designed governance model? Even though it was a hack, it was a poorly designed governance model in which a bad actor could end up benefiting from it in much the same way a centralized entity could. So kind of bringing that back is that some bad practices end up being predatory towards tokenomics or kind of the tokens, and try to really I would say misguide projects into thinking liquidity is the #1 priority. And I think at Goldfinch, we have been approached a couple times with market making opportunities or LP kind of proposals that might try to misguide us to thinking that is the most important. And some of the proposals are a little extreme that we would never consider. It'd be dangerous to the protocol. But the fact that they're coming towards us kind of sends a signal that other people have, or other protocols might have considered it and gone for it. And so I think bringing this back to what's the best practice is, it's okay to have slower and sustainable growth. If you look at kind of the traditional finance markets, you'll see a credit fund or even venture funds kind of slowly go up in TVL over time. It's much more linear. And then if you look at a lot of kind of, I would say, DeFi projects, you'll see a hockey stick growth up. But then if you look on the other side of that, it's hockey stick growth right back down. So kind of what's your moat and how are you building it outside of liquidity is kind of a best practice that we're constantly thinking about.
Fake growth. We have that in the ETF business, where you can see, if you have an ETF with $1 million, it's not going to be as popular as an ETF with 100 million. And then some people self-seed with 100 million, but then everyone realizes there's no real demand there, right? And so it'll have a lot of assets, but won't necessarily trade. But we all have this pressure to grow. Jay, I wanted to get your view of, lessons learned on behaviors.
I definitely agree with everything that's been said, right? I think what Taylor's hitting on is a really important point in terms of long-term thinking, right? And it's in crypto, when you have the 24/7 liquidity that you do, most and a lot of actors aren't thinking in the long term, right? They want to make a big dollar amount today, tomorrow. They don't care about what even happens next week, right? So I think the most important piece within this long-term thinking is actually security. right? If you think about the past like 2 years and who's actually made money in the past 2 years in crypto, I would argue that most people have lost more money in like bridge hacks and in DeFi hacks than they have in any of the yield generated through DeFi products, right? And that's really sad. So long story short, I think that security needs to be improved, not just audits and better technical things, but also just a mindset of long term.
How do you do that?
Yeah,
I mean, how do you check as an outsider, technical person? You want code audits. I guess you can count the number of developers and things, but how do you? It's hard to judge, right?
Yeah, I think that like the big difference here is like crypto has two types of people. It has missionaries and mercenaries, right? And there's one type of person who cares about the token price and what it is today and tomorrow. That's the mercenary, right? But who's going to care about actually building a better financial system? Those are the missionaries, and those are the people who you want to align with, and who you want to work with, and whose money you want to put whose project you want to put your money into, right? So you need to be able to dissect and figure out the difference between these two different audiences, and that will be how we can get to these better security standards.
Okay, I don't see anyone standing at the mic from the crowd, so I'm going to ask another question, which is just regulation. Right, startups, financial world is full of regulations, and it sort of can touch on crypto in a number of different ways. How did you think about that, and was that, like, I guess I'll start with you, Jay, and then kind of work this way.
Yeah, initially we did not think about this enough, right? We were
Sorry, did you say at all or enough?
At Rari Capital, right? We were 3 kids who were not even graduated from high school, just hacking on a project together, right? The first instinct was not, let's go call up a lawyer. The first instinct was like, shit, how do we start a business, right? And I think that like we learned about regulation much later on, right? And the very difficult thing is that you talk to 10 different lawyers in the space, they'll give you 10 different answers, right? Because Gary Gensler and the SEC have not provided clear guidance to any crypto company. Every crypto company is operating in a horrible gray area, and any guidance would be very, very welcome from the government.
It's interesting. I think at Goldfinch we took kind of the opposite approach. We're probably more regulatory compliant. So when we first launched, we were a permissioned protocol. And so at the time, asking the crypto community to KYC themselves was like relatively unheard of. And we had a lot of, I would say, degens or crypto pros who were like, absolutely not. Like, I won't give you any money. And I think taking kind of like a more regulatory or conservative approach has ended up serving us really well in the long term. Because now you have institutional players who are like, hey, we actually won't invest if you aren't permissioned. And it's now a net positive that every single participant has to be KYC'd or KYB'd or accredited. The regulatory uncertainty is definitely, I think I mentioned this earlier, a deterrent. And from that standpoint, I think if we want to look to like a gold standard, I think Circle has done an incredible job being regulatory forward. I think Coinbase is also kind of working with kind of like on the Hill, trying to push a lot of this forward, and hopefully kind of what they are working on together for USDC and stablecoins will be a step in the right direction. But I think there's a lot of institutions on the sideline right now who are kind of waiting for that regulatory certainty before they really take a full plunge into the space.
Well, and do you want to comment at all on how the regulatory environment has affected your portfolio companies?
Yeah, I mean, I agree. I mean, we're hoping for regulatory clarity as well. It's been a common ask amongst our 100+ portfolio companies to provide them with legal help or connect them with the right lawyers who know about US regulations or European regulations, and it's just different no matter what jurisdiction you're operating in, and it's super confusing, especially for first-time founders. So I agree. I mean, I'm excited for, I don't know. I'm devastated, obviously, by what's happened with FTX, but hopefully what comes out of this is a little bit more clarity from the regulators.
Yeah, I'll definitely concur with my panelists here. I think that the SEC sort of being slow to move, slow to give guidance has definitely left us in a very sort of grayish and a lot of very uncertain topics with the crypto space in a whole. Although thinking about the future, I definitely believe that the sort of crypto native future is one where it's still on-chain based, and there might be an interface to KYC, sort of bring your assets onto platforms that are operating in certain regimes. But I think the permissionless innovation nature of crypto will actually always make it so that there will always be sort of a hub of activity buzzing about outside the margins and outside the spaces where normal institutions normally operate within. I think that having crypto itself being the idea of a state-free money, being something that's not being tied down to one institution and really being sort of the freeing institution is very important to the ethos of itself. And having money, but also talent being drawn in that direction really paves the road for, I think, what is hopefully a much sort of freer future than sort of the normal path that a lot of tech industries in general take as a result of their maturation.
Do you have a question?
Yeah, is this on? Hi. Thank you, Mr. VanEck, for helping us create this at USC. Jay, Chris Swain, Ivan Young talk very highly of you, so cool to see you on stage. I did the master's program there. I had a question for Taylor. You mentioned something about all debt going to decentralization. I've never heard that. Could you expand on that a bit and kind of talk about why you see that vision and what it means for the world, perhaps? Sounds like you need more allies to make that happen.
Yeah, so when we say we have a vision of all debt moving on chain, I think we mean anyone from kind of the smallest business in Nigeria to kind of the largest institutional investor or fund in New York can borrow and access capital from the same marketplace. So that just means kind of these global capital market systems are moving on chain. And in doing so, they're more transparent, they're more accessible, and they're more efficient. I think Kathy referenced earlier today is that some hedge funds, they're very opaque. And it's actually those opaque players who get hurt the most or who cause the most harm. And so when we're talking about kind of bringing debt on chain, we're envisioning kind of that whole global capital market system. So you can even see it with some fintechs right now. Obviously, there's Stripe APIs where you can see kind of all of the bank account activity or credit card transactions, and you can start building kind of your on-chain reputation as it comes to credit and debt. And you can see that scaling all the way up, especially once all economic activity is moved on-chain. I don't know if that answers your question, but that's the start of the vision, or if anyone has anything else to add.
Well, I think we could have a whole separate panel, and I'm sorry we've run out of time, but next time we'll have more time for questions. Thanks to the USC Blockchain student group for setting this up and setting up the whole conference and allowing us to take the stage for a little bit. Thanks, and thanks to my panelists.